So Healthcare Services Group, they just dropped their Q3 earnings and the stock went absolutely nuts. But here's the thing. Was this a genuine home run or was it something else entirely? A little bit of a sugar rush, maybe? Well, that's what we're here to figure out. Let's dig in. And when I say nuts, I mean it. Check this out, a nearly 14% jump in a single day. I mean, wow, that happened right after they released their numbers on October 22nd. Now, a move like that, that's the market screaming that it loves what it sees. But, and this is the big question for us, right? Was that excitement actually justified? Okay, so here's how we're going to break it all down. First, we'll look at the big numbers that got everyone so excited. Then, we're going to decode what was really behind that earnings beat. After that, we'll dive into management's playbook and what they're planning. And finally, we'll give you our take on what to expect for the next quarter. All right, first up, the headline numbers. And let me tell you, on the surface, this quarter looked like an absolute monster. Okay, take a look at this. Revenue? Pretty solid, beat by about $4 million. Nice. But that's not the story. The real story, the thing that sent the stock to the moon, was the earnings per share. Look at that, 59 cents. Wall Street was only looking for around 21 cents. That's not just a beat, that's almost a triple. And whenever you see a beat that massive, your first question has to be, wait a second, what's really going on under the hood? And that's exactly where we're going next. We're going to pop the hood and really question the quality of this beat. So here's the big mystery we have to solve. Did this monster number come from their actual day-to-day business, servicing senior care facilities? Or was it just a one-time sugar high? Getting this right is absolutely critical. And here it is, this something else. It's called the Employee Retention Credit, or ERC for short. Now, this is basically a tax credit left over from the pandemic. And for HCSG this quarter, this wasn't just some small detail. Oh no, this was the star of the show. And this right here shows you just how big of a deal it was. You see that big, flashy 59 cents in GAAP EPS? Okay, now watch what happens when you pull out that one-time ERC benefit. Poof. It drops all the way down to about 23 cents. Now look, 23 cents is still a beat over the 21 cents Wall Street wanted, and that's great. But it tells a totally different story, doesn't it? A much more normal story. This chart really puts it in perspective. Out of that 59 cents they reported, a whopping 36 cents of it was just this ERC benefit that had nothing to do with their core business. The real underlying operations, that generated the other 23 cents. See the difference? And this is why the pros were looking past the headline and digging right into this part of the story. And it wasn't just earnings. This ERC credit also gave a massive boost to their cash flow. We're talking about an extra $31.8 million in cash from operations. Now, that's awesome for the bank account this quarter for sure, but it's a one-and-done deal. You can't count on that showing up again. Okay, so we've peeled back the onion. We've separated the one-time noise from the real signal. So the next logical question is, what did management have to say? How are they spinning this, and what's their plan going forward?
Oh yeah, they came out swinging. The CEO, Ted Wall, was all about momentum. He basically said, yeah, the quarter was great, and we're carrying that energy straight into Q4. The whole vibe of the call was, hey, look at our core business, we're winning, we're keeping clients, we're executing. And they didn't just talk, they gave us real numbers to look at. For next quarter, Q4, they're targeting revenue between $460 and $470 million. And this is super important. They gave us cost targets. They're aiming to keep their cost of services right around that 86% mark. And for their corporate overhead, or SG&A, they're shooting for 9.5% to 10.5%. That kind of discipline, that's what you want to see.
So what's the playbook? Well, it's pretty straightforward. Keep winning new clients, keep the ones you have, and they're doing a great job of that with over 90% retention. They're also trying to cross-sell more services. And they're being smart with their cash, buying back a ton of their own stock and even sniffing around for some M&A opportunities. You know what else is helping? They've got this massive industry trend, a huge tailwind pushing them forward. Think about it. The senior population is growing, so demand for care is going up. But the supply of new facilities? It's tight. That's just classic economics 101, and it creates a really, really favorable environment for HCSG. Okay, let's recap. We've got a noisy Q3 with a solid core business hiding underneath. We've got clear guidance from a confident management team, and we have a great industry setup. So, what's our call for the next quarter? Here's the Talk Tickers forecast. We're penciling in revenue right at the midpoint of their guidance, so let's call it $465 million. For the real adjusted earnings, we're looking for a small step up to about 24 cents. But here's the key theme, the big takeaway. Q4 is going to be a prove-it quarter. All that ERC noise is gone. It's just going to be about pure, simple operational execution, and that's when we'll see what this business is really made of.
And because of that, we're officially slapping an outperform rating on HCSG. Our thinking is this. The market went wild in Q3 for the wrong reason, that big, flashy headline number. But in all that excitement, we think it missed the real story, which is that the core business is actually doing really well, and it's about to prove it. So, that leads us to our favorite part. We call it the outrageous but plausible trade idea. Because when we see what looks like a disconnect between what the market thinks and what's really happening, well, that spells opportunity. The thesis is simple. We think the market is still distracted by the ERC noise and hasn't fully appreciated the strength of the underlying business that we saw in Q3. The trade idea? It's straightforward. Long HCSG common stock. And the catalyst is right around the corner. It's that clean Q4 report. When they deliver that with steady growth and good margins, we think it's going to force a lot of people to take a second look and re-rate this stock based on its real fundamental strength. But looking beyond just the next quarter, here's the big question you need to keep in your back pocket. Can management actually get control of labor costs and hit their long-term expense goals, especially with inflation being what it is? I mean, if they can pull that off, this isn't just a trade, it's a real long-term value story.
Okay, and just to be perfectly clear, remember this is for informational purposes only. It is not financial advice. Always make sure to do your own homework.